It was the consensus not so long ago that rates in the UK were going to start to come down gradually in 2024 and well into 2025. But a lot of that seems to have been dispelled with the Bank of England now choosing to hold rates at 5.25%. And it seems Andrew Bailey wants to be a legend in his own lifetime. So in this video, we're going to be discussing how we got here, what we can expect the future to look like, and how you can help to prepare your finances. Right, we're going to raise interest rates and make a load of people unemployed. These two things are not connected. This doesn't make any sense. So if we just rewind just a little bit, rates started to go up in order to quell surging inflation as it was on the rise that peaked at about 11%. And this inflation was considerably higher than most other comparable economies. And rates have basically been held at 5.25% since August 2023. So what you're starting to see is this gradual move towards decreasing rates, but they're still kind of outweighed by quite a majority there before we start to see any real movement in the direction of rate cuts. First, we'll look at the Bank of England's forecast. Now, one of the things they talk about in the forecast is that they expect inflation to start to dip down towards 2%, kind of towards the end of the year, but then they expect it to tick up again into 2025 and then level out again in 2026, as the graph shows. But one of the things I think is kind of revealing is that the Governor of the Bank of England, Andrew Bailey, has said, and I'm paraphrasing here, that they're not going to look to cut rates until they're comfortable that inflation is going to be at or below the 2% target for an extended period of time. And I think that's worth noting. And again, it's something we're going to come back to in the conclusion at the end, but it's just a really useful thought to bear in mind as we're going through this video, that they're not just aiming for once it hits 2%, boom, rates are on the way down. No. What they're saying is the rates have to stay below 2% for an extended period of time, which may transpire to be much more difficult, as we're going to discuss. And one thing that I think I've certainly not seen discussed anywhere else is that the Bank of England has a plethora of possible tools when it comes to trying to stimulate the economy. They've got not only interest rates, but they've got quantitative easing, they've got bond buying, they've got all sorts of liquidity tools that they can start to deploy. But actually, when it comes to trying to take some steam out of the economy, interest rates are kind of the only tool that they've got. And if you're a hammer, everything looks like a nail. So what's driving inflation? We have another video just here where we discussed why the UK has a higher rate of inflation than other comparable economies. But one of the things that we just cannot avoid is that the UK, by virtue of being a net importer, is going to be more vulnerable to external shocks. So we've got the war in Ukraine, sent gas prices absolutely soaring through the roof at the wholesale price, which has then filtered down to the domestic prices. We're starting to see some disruption in trade in the Red Sea, which is undoubtedly going to have an upward pressure on prices, which is not going to necessarily lead the Bank of England to cutting rates. Government policy. Now, in the 1990s, they had this really good idea, but that does lead us to an interesting conundrum which we face, which is the Bank of England is over here. They're raising interest rates, trying to take some steam out of the economy because they say that the economy is overheated and that's what's causing inflation. But then over here, you've got the government cutting taxes, which in theory is an inflationary pressure to the economy. It's putting more money in people's pockets in order to get people out there spending money, buying new cars, going out for dinner, all of that kind of shit. So we have these two forces which are working in opposite directions. Now, they are not necessarily equal and opposite forces, but they are opposite forces nonetheless. Now, I am extremely cynical. An election is likely coming, so I think it's fair to say that these tax cuts are basically a giveaway to try and get people more on side. I mean, how stupid do they think we are? You'd have to be fucking moronic to not see that. But never mind. I digress. Apologies for that. I've digressed a little bit. Let's get back into it. Remember earlier when I said if you're the Bank of England and the only tool you've got is a hammer, everything looks like a nail? Well, this is kind of what I'm talking about. So we have the war in Ukraine that sends wholesale gas prices through the roof. So the Bank of England says, right, we're going to raise interest rates and make a load of people unemployed. And you're just like, how are these, these two things are not connected. This doesn't make any sense. So what conclusions can we draw? And I think you get to this quote here from Andrew Bailey, and he's basically saying that it's not just a hit 2% and then rates start to come down. It's hit 2%, maybe a bit below, and it has to stay there consistently. We should include this really important caveat, which should not be overstated, and that is there are a lot of potential external factors which the Bank of England has no control about, whether it's conflict in the Red Sea or anything like that. All of these could send inflation soaring up again, and so put the whole plan into a potential tailspin. So that's always worth bearing in mind. Now, what can you do in order to prepare your finances for this? Well, I think there are a few key things that you can be looking at. The first is, if you have debt, to refinance it where possible. Second, having a good sized emergency fund is always going to be worthwhile doing. Even outside of higher interest rate environments, it just means that you don't necessarily have to go into debt if you have a big bill that you have to pay. You can just pull out of your emergency fund. That's what it's there for. And then finally, one of the few pieces of good news is make sure you're taking advantage of these higher interest rates. Thanks very much for watching. If you've liked this video, please like and subscribe below. Peace.